If you can start trading options and master it, you can create an income generating machine for yourself. But if you don't have the right foundation from the start, you can spend years spinning your wheels, losing money, and finding yourself more confused than ever. There are millions of traders out there and thousands of ways to trade, so I get it. The trading world is a bit confusing. That's why what I'm going to show you here today has been simplified so that you can follow a step-by-step process and actually get started with your own options trading. You're going to learn about mindset, charting, trading platforms, option contracts, option chains, practice trading, funding your account, and most importantly, how to take all this information together and put it into your own personalized trading plan so you can get started on your options trading journey today. So before you jump in, it's really important to understand, why do you want to trade options? It's your reasoning, and having a clear goal will guide you in your decision and keep you focused when things may not be going so well. Maybe you're looking for some kind of extra income, like generating cash flow through selling of covered calls. Maybe you're going to use your option contracts to hedge your portfolio and kind of protect yourself in case the market sells off. Or maybe you're just drawn to the idea of leveraging a smaller amount of cash up front for a potentially larger return over time. So whatever your reason is, it's important to match your strategy to your own specific goals. For example, if you're looking to build wealth slowly, which is the easy way to do it, you may want to be more conservative with your strategy, like selling cash secured puts or using covered calls. If you want to be more aggressive, maybe go with the get rich quicker type mentality. You're going to have to take on a bit more risk, and that comes through buying calls or buying puts. But understanding your why will set the foundation for a disciplined and effective trading approach, and one that's definitely tailored to you specifically. Now let's talk about one of the most essential skills when it comes to trading. We're talking, of course, about how to read a stock chart. And this is how you interpret stock movements over time and set up your trades to hopefully be profitable. We're here inside of TradingView right now looking at the Apple stock chart. And this TradingView platform is the most widely used one for trading out there today. I recommend getting yourself a free version of this platform just because you can go in, you get some things like this set up, get your watch list built, and then go and start learning how to read this stock chart. And the next thing you're going to want to learn about is the battle between the buyers and the sellers in the market. And this is where reading candlesticks comes in, is very useful. On this chart right now for Apple, we have a D, which is a daily candlestick chart, which means that each candle you see here, that's 1, 2, 3, 4, 5, all the way through, is 1 day of price movement for the stock of Apple. Zooming in here, we'll get into the candlesticks and how they work. For this green one right here, we can see that we have an upper kind of wick, which is a skinny line, a body, which is this fatter line in the middle, and then a lower wick down here. What this is telling us is a few things. At the top of this green candle, that is where the price closed for the day, which means that this bottom of the body is where it started for the day. So it opened down here, went all the way up here and closed at this point right around that 209.40 level. What the wicks tell us is that the price also fluctuated beyond the open and close to the ultimate high of the day, which is right up here, right around 213 and change, and the low of the day was down here around 196. So from 196 all the way up to 213, but it opened the day right around that 198 mark and closed it higher at 209. So a green candlestick will always open low, close high. And conversely, let's find a good red candlestick to look at right here. We'll look at this one over here because it's got the same kind of pattern right there. You can see this one right here in the middle. This guy, it's a red candlestick, which means that the price opened right here at this top end of the body, closed down here, so it went lower, and it had the wick on the upper end where the price moved up higher to, but it obviously didn't work that way because more sellers jumped in and drove this price lower, all the way down to the low of the day around 168 and change, ultimately being propped back up at some point by the buyers, finishing again right around that 169.37 level. Open here, close here, high of the day, low of the day, bango bango. That's what you need to know about candlesticks. That's how they work. And once you have the ability to understand a stock chart like this, it's time to give yourself a chance to form your hypothesis about where the stock price is headed next. Okay, will the stock price go up if you're bullish? Will it go down if you're bearish? Or will it kind of stay the same and float along if you are neutral? Now, let's say the stock, just like Apple is, it's kind of consistently making higher highs. The stock price is going up, it kind of comes back down, but then the bottom point of this, the trend, keeps floating higher and higher and higher and higher. We can actually connect these dots with a trend line right here, kind of move these all together and say, boom, that's kind of our trend line that's in play, maybe a bit lower like this, where we're just connecting the dots on where the price is kind of dropping to a few times. and obviously went through it here once, but then shot right back up. That's kind of the general direction where the stock price is going. And if this is what you're seeing, it's usually a bullish sign that the stock is going to continue doing this. Obviously, not 100% guaranteed though. On the other hand, if you see a stock price like this that's kind of floating higher, and then there's a nice trend line where the stock price has touched it a few times down here, it hit it here, bounced off it here a couple times, but actually then it broke through right here and couldn't regain this trend line and go to the other side of it, heading higher still, then you can see that stock is starting to struggle. If we look out and zoom out a bit more, we can see that moving forward in time, the stock continued to kind of drift lower and sell off over here, leading to a bearish move in the stock price. So you got bullish or bearish, and sometimes the stock doesn't really do a whole lot, and it's going to just meander back and forth right here. It's going to kind of just go and kind of, it's range bound, let's say. It's going to just kind of go up, it's going to go down, it's going to kind of just chop around for a bit. And that's what's known as being neutral. It's not really kind of a defined upward or downward pattern. If you zoom out there maybe, but in the meantime, in the midterm, there isn't really one way or the other that the stock is going to move. So you've got your bearish, you've got your bullish, you've got your neutral, and knowing these things and having these hypotheses will allow you to make an educated decision on what type of option contract you're going to use or your option trading strategy. So with our hypothesis in hand, it's time to pick the right option contract type for your trading. And there are two main types. There are calls and there are puts. And if you believe a stock is going to rise or you're bullish, like we showed on the chart, you would potentially buy a call option, giving you the right to buy the stock at a specific price. Or you could sell a put option, getting you paid for taking on the risk of potentially having to buy the stock. Those are two ways you can profit from a bullish move with an option contract. And if you think the stock price will fall or you have a bearish outlook, you could then buy a put option, giving you the right to sell the stock at a specific price, or you could sell a call option, preferably a covered call option where you own at least 100 shares of the underlying stock already, and you would then get paid to potentially have to sell them on the market. Each option contract has key details that you would need to pay attention to, known as the strike price, the expiration date, and the premium involved, which I'm going to show you on an option chain in the next part of this video. And the strike price is just the level that you can buy or sell the stock at. The expiration date determines when the stock option is valid for, how long the contract is. And the premium is just the cost that the buyer has to pay to open the contract, and it's the amount that the seller of the contract gets paid. And for beginners, the most success is going to be by tilting the odds in your favor. This comes with selling options, in my opinion, versus buying them. The more small wins that you can get in the beginning, the more your confidence will grow. And as you gain confidence, you can then explore the more advanced things like buying calls, buying puts, spreads, and iron condors. You can also level up your understanding of option contracts with my Options Academy intro course right up there. Now, the option chain is where the magic happens. It's your menu of available contracts, and at first glance, it can look overwhelming, but it's straightforward once you know what to look out for. This is an options chain inside my brokerage of choice, Interactive Brokers. On the option chain down the middle, you can see the strike prices right here. This is the prices of the contracts that you're going to agree to buy or sell the shares at. You can see that there are puts on the right-hand side at the top and calls on the left-hand side. And each row shows the price of the option for the calls and the puts at, again, that specific strike price. You see that the expiration dates are on the top left-hand corner, with 6 days currently being showed as January 17th. February 21st is 41 days away, March 21st, 69 days away, April 17th, 96 days away. We can click this more button to go all the way out into 2026 and even 2027 currently right now. So the other thing we talked about is premium, and premium in your option contracts is the bid and ask spread. That is the difference between the bid, what people are willing to pay, and the ask, what people want to get paid. So somewhere in between here, let's take the 230 strike price on the put side. If you were going to sell this put option, it would get you about 4.85. If you were buying it, 4.95. So you'd probably make a deal in the middle at about 4.90. And remember, every option contract is made up of 100 shares, so it's actually 4.90 times 100. So the seller would get paid $490. The buyer would have to pay $490 to enter into this put contract at the 230 strike price, February 21st, 2025, expiration 41 days away. On the call side, if you want to look at this, if you wanted to buy a call option at the 220 price, well, it's going to cost you $20.40 or $20.25. So somewhere in the middle, let's call it $20.30. and that would give you a call option for about $2,000, right? If you're the call option buyer, it would cost you about 20 times 100, so $2,000 to buy this contract. And as the seller of this, you'd get paid about $2,000 to take on the risk of having to sell those shares at 220. You'll also see details on both sides here: option interest, volume, delta, theta. They are more advanced kind of terminology, some implied volatility number here in the top right-hand corner. But as a beginner, it's important to focus on options with high liquidity, which means that the bid-ask spread is as close to each other as possible. 485, 495 is pretty good. 6 and 685 is a bit too far apart. For reference, 955 and 10 is a bit too far. Again, I would try to look for something a bit closer, like the 690, 7.2. That's pretty close. Or even here, 2025, 2040. Those are good ranges for your bid-ask spread right there. And the reason that you do this is because you can get in and out of your trades quicker, the more liquidity or the more tightly bound that bid-ask spread is. And so also think about this when you're choosing your expiration dates. Understand that the short-term options, like the 6-day option, is much riskier, especially if you're buying it, versus a 41 or a 69-day option for expiration. If you're going to buy quick ones like this, you have to get the direction right away. So if you're bullish and you buy a call option, it pretty much needs to move right away in the direction that you want in order for you to make money. If it doesn't, you're probably going to lose your capital in the trade. But these longer term expiration dates, March, April, they just give your trade more time to work. So there's not as much of an onus on the stock moving right away the way it has to. It'd still be okay a week or two later on versus moving exactly how you need to the first day that you make the trade. So before you can trade, you need a brokerage account to open up your own trading account for yourself. And there are plenty of options out there. Interactive Broker is the one that I use. I've been using for the last 5 years, and all the videos on my YouTube channel kind of show you how to use and operate that platform. There's Thinkorswim, there's Charles Schwab, there's Webull, there's tons. Choose one that you think is going to match your trading style for doing some research, and look for features like low commissions, something that's really user-friendly and has good educational resources in case you can't find answers on YouTube for the platform that you end up deciding to go with. There is a really good article here from NerdWallet that's going to give you a kind of quick and dirty overview of all these different trading platforms that you can use. You can see there, Interactive Brokers is what I use. But there's a whole bunch of them on this list, and just go through, do a bit of digging, do a bit of research, figure out which one you think looks the best to you, and then make your call and open up your paper trading account, which I'm going to say almost all of them offer for your own kind of practice trading. And I'll make sure to include a link to this site in the description of this video if you want to check it out for yourself. And once you've opened up your trading account with your brokerage of choice, make sure you practice your trading strategy with a demo or paper account where the money isn't real, it's all virtual, and you can learn how the platform works, you can test your strategy, you can do it all without risking any of your real cash. Spend a couple of weeks doing this and just understand how it works, how to get in and out of your trades before you go ahead and make your actual first live trade with your own real cash. And when you're ready to trade for real, it's time to fund your account with your own real capital. I would say start with an amount you're comfortable losing, because worst case scenario, you lose it all. It won't be something that's going to break your back financially. So put a small amount in that you can afford to lose. And once your account is funded, there's two things you're going to want to do. You want to go ahead and look and set up your trading permissions to make sure that you're actually allowed to trade option contracts. Some brokerages make you kind of go through and sign some forms saying, yes, I do understand how they work. I do understand the risks behind them. They just want to protect you from yourself, to understand that you actually do know what you're doing and you do have a baseline of knowledge to make these trades. The second thing that you're going to want to do is set up a market data subscription. This involves giving you kind of the access to actually live time stock market data. So all the prices of all the stocks you want to trade live. If you don't get this, you're going to be trading with 15 minutes of delay in your data, which is very hard, almost impossible to do. There's a reason why professional traders get like up to the millisecond of data that they can. You want to have live data, so you pay a couple bucks each month for it in your account. It gives you real-time quotes. You can actually do live trading versus 15-minute delay, which I would not recommend anybody does to try to make an actual profit in the market. Then once you're all ready to go, you're set up, start small. Just one contract to start for your first real trade. Minimize your risk as much as you can. The goal at this stage isn't to make a fortune, but just to gain experience and gain reps and gain understanding of how the actual stock option trading works and feels for you specifically. So now let's put it all together for you in a step-by-step process for you to walk through and have for yourself. We're going to put everything we talked about today, your mindset, your chart reading, your bullish, bearish hypothesis, the type of option trade you want to make, the paper account, the transferring your cash, actually trading live, all of it together onto your own simple timeline. So on day number one, I would say open up your TradingView account for free. Make sure you can open up your charting platform. You get that in there going. I would say open up your paper trading account as well on the first day, just that it's there, it's ready to go when you want to use it down the road. And then on day one as well, look at a couple different stocks that maybe you have in the back of your mind that you may want to trade. You probably know a couple already that you're familiar with. Put them into your stock chart and TradingView and look at them and see if they are bearish, bullish, neutral, what kind of patterns you can see on the stock chart yourself. Maybe go back and rewatch that section of this video on the candlestick reading as well. And then day two, I would start to explore the option chain a bit inside your brokerage account for, again, whatever platform you take. And I would just look at the strike prices, look at the expiration dates, look at the premium between the bid and asks, and get familiar with those things on day two. Day three, I would go in and I would make a paper trade. I would go through and say, hey, I've got my bullish bearish hypothesis for where it's going to go based on my chart. I understand where the chart has been, what kind of it's been doing lately. I understand that I want to go bullish. So if you're going to go bullish, again, you maybe want to buy a call option or sell a put. If you're going to be bearish, you're going to be selling a call or buying a put, and just go through there, make your paper trade and practice it and get it in the hopper. And then from day 4 to 14, I would just kind of review different companies that you're looking to trade and also monitor that ongoing trade, that paper trade that you made. So at the end of that kind of 2-week period, you're going to see for sure if it's kind of worked in your favor or if it's gone against you. And you can understand if it's performed as expected or if you need to adjust the strategy a little bit based on what you're seeing on the chart and how the stock actually performed as well. So you're going to see how the stock performed, how the option performed, and what you need to kind of do to tweak your strategy at all, if you need to tweak your strategy. And then I would say, yeah, between day 15 and 30, somewhere in there, if you're feeling comfortable enough with your paper trade, you know how it all works, now to execute your trade, go make your first live real trade, fund your account, make that live trade, and just go through the motion, see how it feels, because I will tell you, it's a lot different making your first real trade with your own money. That's why I want to keep it very, very small versus making a trade in the paper world. It just doesn't feel the same, but it's good to get the reps in anyway. But that first real trade is going to hit a bit different for you. That's why we keep it small. We manage our risk, and we hopefully get it right from the outset, but you don't set yourself up for failure time and time again. And from there, it's just practice, repeat, and keep going after it, keep getting better, 1% better each day. When I started out back in 2019, I was trading options from my phone only, no desktop trading. I was learning how to sell put options on stocks that I wanted to own long-term, so good blue chip stocks. I was trying to limit the amount of times that I got assigned those stocks, and I was trying to generate some income and trying to generate cash flow from my phone, doing it on a mobile device. I now do it based on mobile, based on my desktop, wherever I happen to be that day, but I still use the same principles that I share with you here today. I analyze the markets using charts and candlestick patterns. I look if it's bullish or bearish. I select the best option contract, strike price, and premium available to me based on what I think I'm seeing in the market. I have a clear risk management plan in place, not risking too much, keeping things small and kind of defined on my scale. And I review the trade, journal it, and look at it afterwards to learn from the experience and just try to get better over time. That's all you can do. That's what this game is about. And this process helped me stay consistent year after year, trade after trade, and just kind of get me to that place where I'm more confident than ever in my trading decisions. And options trading in general may seem intimidating, but it's incredibly rewarding once you get the hang of it and understand that kind of how freeing it is. So just remember to start small, practice consistently, and always prioritize learning and making good trades over making money, and you'll set yourself up for a lot of success in your trading experience. If this video helped you at all, make sure you subscribe for more options trading tips and content. And if you want to learn how to open up your own paper trading account from start to finish with Interactive Brokers, check this out right here.